-1 full percentage point. From New York City coming up, Gene Tenuto, Columbia Threadneedle's global head of fixed income. He'll join us in the next hour. A bit into the Treasury markets, yields heading south by 6 basis points.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. In France, Emmanuel Macron has won another shot at convincing the public that his pro-business, pro-European vision can work for them. Macron won a second term as president, beating nationalist Marine Le Pen with more than 58% of the votes. Macron acknowledged that some of his support came from people who don't actually support his ideas but wanted to keep Le Pen from winning. And it is the highest level U.S. visit to Ukraine since Russia's invasion. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin met with Ukraine's President Volodymyr Zelensky in Kyiv late Sunday night and promised more military aid. The U.S. also says it would start sending diplomats back to Ukraine. And Bloomberg's learned that Elon Musk met with Twitter executive Sunday about his takeover offer. The company is said to be turning more receptive towards that $43 billion bid. Musk's offer includes backing from Morgan Stanley and other financial institutions. Twitter has previously considered thwarting that takeover attempt. And the price of oil fell below $100 a barrel on concerns that the spreading coronavirus outbreak in China will hurt global demand. WTI futures fell almost 5%. China's demand for gasoline, diesel, and aviation fuel this month is expected to fall some 20% from a year ago. And Bloomberg's learned that private equity firms, including KKR and CVC Capital Partners, are considering bids for Toshiba. The Japanese conglomerate had said it would open the door to potential buyers. Toshiba's management and shareholders have been at odds for years over the company's future. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City, some breaking news for you. Let's get straight to Twitter. The offer from Elon Musk, $54.20. The price right now, getting closer to it, $51.69, up more than 5%. Twitter said to be on track to reach a deal with Elon Musk as soon as today. According to a source, they're in the final stretch of negotiations. They may ink a deal as soon as today if these talks go well. They also say that talks are fluid. The deal could still be delayed or fall apart. This coming off the back of a Wall Street Journal report over the weekend that Elon Musk met with Twitter executives over the weekend. Twitter 51.65. Tom Keene, we're up by more than 5.5% in early trading.
And what do I do on this? I go to the terminal, John, and I go to the acclaimed BQ screen, and I look at price to sales. Twitter is such a growthy story, John, and so much about hopes and prayers and all the rest of it. We all know this ballet that I really don't go to profit metrics. I just want to know what the price to sales is. I got a working number of 7.69. I think that's at a price of 48 and now elevated 52. Maybe we're going to get out to 8 times sales.
Bramo traded in the 40s through much of last week. I think the price action spoke for itself, didn't it, Lisa? This market didn't really think we'd get there anywhere near to a deal. That's changed over the weekend. Elon Musk met with executives. Our story this morning, we're now trading in the 50s again.
That, I think, is the most significant part, regardless of what happens. I mean, these deals may fall apart. However, the talks are more serious. It seems like the Twitter board is fighting less and engaging more, and this is a change from initially when we heard about the offer. This might not be a hostile takeover the way that a lot of people had expected at the outset.
Ed Ludlow joins us on the West Coast on the phone. He's been following the story closely for us. Ed, let's start here. What's changed over the weekend coming into this week?
A lot. It's been a busy weekend, John. I mean,
I think we might have lost Ed Ludlow just briefly. Ed, just take a beat. We'll re-establish that connection and we'll come back to you in just a moment. 51.51, if you're just tuning in the pre-market on Twitter, up by more than 5%. As we said over the weekend, Elon Musk reportedly met with Twitter executives. That story reported first by Dow Jones, the Wall Street Journal. Our story this morning suggesting, according to a source, that Twitter may ink a deal as soon as today, Tom, if these talks go well.
Morgan Stanley supposedly involved in that. Do you think that changed the dialogue?
Let's get to Ed Ludlow again, Tom. We've re-established that connection. Ed, great to have you back with us, buddy. Second time lucky, I hope. Run me through it.
Right. Yeah, so, I mean, Tom's exactly right that over the weekend, Elon Musk held video calls with the key investors. He met with Twitter executives. This is him playing his best hand, right? According to sources, trying to sell his best vision of how he changes the Twitter platform, how he boosts revenues. He's being really active in this, and it's just as how it played out over the Easter and Passover weekend. He has his bankers working the deal. He himself is working the deal. And as you said, according to a Bloomberg source, if all goes well, something could come later today.
How important is it that Morgan Stanley is reportedly involved? They've got a huge tech history out there. These are names people can be comfortable with. How important is that in the banker-to-banker chat?
Crucial because of all of the parties involved in this, right, Tom? That Elon Musk is trying not just to secure the debt financing, which he did, that's $25.5 billion, part of the deal, but he's also been vetting equity partners, high net worth individuals, family offices. He has to convince a lot of folks if he wants this deal to happen.
Well, not only that he wants the deal to happen, Ed, but that he has financial interests at heart when he talks about the deal. He talked a lot about how he wanted this for the idea of free speech, not necessarily an economic interest. That doesn't sell to investors, does it?
No, it doesn't, and you're exactly right, Lisa. There was a key piece, according to sources, that kind of contradicts that, which is in the PowerPoint presentations, which, as you know, in any deal, the deck is so important. There were slides about how he plans to boost revenue. This has always been the question for Twitter. How do they monetize the full potential of the platform? You know, they have very modest top-line numbers compared to some of the social media giants they compare with. How is he going to improve that? And apparently that was a big part of his selling.
Ed, I'm also wondering about the financing of this. You talked about the $25.5 billion in debt financing. Of the equity investors, how much is Elon Musk himself backed by Tesla shares that could be put on the line should this bid go through?
Yeah, the math's really important. So Elon Musk only has $3 billion of cash or cash equivalents as part of his net wealth, right? So one hypothesis was that he'd sell down some of his Tesla stake to become more liquid. But he has other options, right? He, according to sources in our Bloomberg reporting last week, he could front, say, $5 to $10 billion of that 21 to either selling down Tesla shares or even some of the private stakes he has in other businesses like Boring or SpaceX. And then the remainder of the 21 comes from people that he wants involved in this process, right? The names that we've been talking about across private equity are still there. They're still being mentioned. Tom Bravo, Silver Lake, of course, already has a seat on the board at Twitter. So it'll be interesting to see how that remainder of the financing plays out.
Ed, do we know what Elon Musk's plan is for the platform?
Yeah, I mean, concisely, it's 4 buckets, right? The first is that he wants to open source the algorithm. He's constantly complaining about bots. You know, John, when you and I engage with each other on Twitter, a lot of bots tend to reply. He wants to get them off the platform. There's been a big question around, for example, President Trump, right? President Trump is banned from the platform, and Elon Musk has talked about how he doesn't believe in outright bans, but perhaps timeouts. Think of it as like I don't want to go into a rugby analogy, but think of it as a timeout, right? I was going to say yellow card in rugby football. And then the fourth, I know Tom's going to kill me for that one. And then the fourth bucket, basically being, you know, democratizing the platform. It talks about open sourcing the algorithm, but I think that he's pretty fed up with the content moderation uncertainty, you know, that he basically tweeted a few days ago, if the far left on the platform and the far right on the platform are annoyed, you know that your policies are in a pretty good place.
I was enjoying the rugby analogy. Ed, you never finished it. Ed, thank you, buddy. Yeah. As always, Ed Ludlow on the West Coast, following the news on Twitter. Over the weekend, then, the Wall Street Journal reporting that Elon Musk met with Twitter executives that perhaps we could secure a deal this week. Our source here at Bloomberg indicating we could reach an agreement as soon as today if negotiations go smoothly. Twitter in the final stretch of negotiations about a sale to Elon Musk, according to a person with knowledge of the matter. So here we are in the pre-market, approaching, for once, the offer price, which is $54.20, right now $51.50. Lisa, a turnaround again. We're getting closer and closer to that offer price from Elon Musk.
Some of the issues for Twitter's board is assessing their own value themselves, trying to come up with some sort of estimate so that they could say, go back to Elon Musk and say it's not high enough. I also think it's fascinating that his pitch to Wall Street got so many investors on board, and I wonder how much that's a game changer for the board. If it's not just Elon Musk going at it alone and going rogue, if he's coming in with real Wall Street money, does that change the nature of this bid?
Fair to say that someone who won't be supporting the bid perhaps is Bill Gates, given the tweets over the weekend. Did you see that over the weekend?
Goodness, yes.
What was that about?
Absolutely low blow. And he came out again and talked about how he is not going to be distracted in the same kind of way. But, you know, if you want to describe the tweet, you can go ahead about
I'll take a pass.
Yeah,
not exactly keeping a low profile as he negotiates this particular deal.
You're trying to get me to describe that, weren't you?
No.
I really didn't want to.
I would never do that.
Okay.
Futures down about 0.7% on the S&P. On the Nasdaq, we're down 0.8%. Just a massive week for big tech this week. We will hear from Microsoft and Alphabet tomorrow. Earnings from Facebook on Wednesday. Apple on Thursday. The main event this morning, though, a shakeout off the back of what's happening in China. The lockdown spreading potentially from Shanghai to Beijing. That takes Treasury yields lower and crude lower too. But Twitter up more than 5% in the pre-market to 51.50. That gets your attention. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. That we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning, good morning to you all. A shakeout in the equity market worldwide. It starts in China, bleeds over to Europe and continues stateside. Futures on the S&P down 0.9%. On the Nasdaq 100, down by more than 1%. On the month, down by 10 percentage points. The worst month for the Nasdaq 100, potentially going all the way back to 2008. Thank you for that, Tom King.
Thank you.
Romain Bosty with some moves this morning. Good morning, Romain.
Hey, good morning, John. Of course, coming off the big sell-off that we saw last week, that appears to be continuing on this Monday morning here in the pre-market. Keep in mind, on Friday, you had about 97% of the members of the S&P 500 decline. That's the biggest percentage of decliners that we've seen going back to November 30th. And that's a key date because, of course, that was the date that most people thought the Fed turned hawkish when Powell gave that testimony before that Senate committee saying it's time to retire the word transitory and speed up potentially the rundown of the balance sheet. Apple, Microsoft, Amazon, 3 of the top 5 weightings in the S&P 500. Lower here on the day, this coming off 2% plus declines on Friday. All 3 of these companies reporting earnings this week, and the setup is pretty brutal. Microsoft, Amazon down double-digit percentages on the year so far. Apple down about 9%. Keep in mind, we're also going to get a few others like Alphabet as well. So the potential for some volatility here heading deeper into the week certainly going to be in the cards, not only because of the hawkish pivot by the Fed, but as you just mentioned, some of the concerns now about potentially additional lockdowns in China. If you're looking for a bright spot, there are about 12 S&P 500 companies in the green this morning. Twitter, of course, being one of them. Those shares higher now, guys, by about 4.5%. This after the latest Bloomberg News report saying that the Twitter board is in discussions and potentially near the end of discussions with Elon Musk on that 54.20 bid. It does appear, at least based on Bloomberg reporting, that they might actually be warming up to that. We should point out at 51.20, this is actually the closest that the shares have actually traded to that since that bid was announced. Remember, the real pop here came, Tom, when Musk first disclosed that passive state. The shares rallied to like 54 something, but they've been drifting lower ever since, kind of in a holding pattern, as a lot of investors kind of didn't want to fall for the okie doke. But it does appear that maybe something is afoot right now between Musk and the board, something to keep an eye on, Tom, as we get deeper into the day.
Romain, thanks so much. M News on Twitter through the afternoon into an eventful earnings week as well. John, they act China here for the 3rd or 4th time since the beginning of the pandemic. They come in from a 13 level into an 11 level on the amount of reserve statistic, the RRR for China. This is just a measurement of China, and we get a yuan move, John, right off this.
Yeah, just a little bit, but still at 0.9%. This is quite a move on the currency pair on dollar yuan, Tom, and it's the 5th straight day of Chinese currency weakness. It's something we've started to see this year, more recently, something we did not see last year.
And an indication of making it up as you go, particularly wrapped around COVID. Sobrado Japa knows that. It's Societe Generale, head of U.S. rate strategy, about making it up as they go. Sobrado, on a Monday morning, and I've called it Recalibrate Monday, Everybody's readjusting into the equity market, and I would suggest your world always leads. If I'm in the equity markets, what's a single sentence I need to read from SocGen fixed income this morning?
Well, the fact that you have the Fed next week is going to be really what drives market sentiment for a good portion of this week. For the most part, the market is fully priced in for a 50 basis point rate hike at next week's FOMC meeting. So it's going to be a little bit of an adjustment process with all the news you're going to get on, like you mentioned earlier, China, as well as developments overseas with the elections in France. So it's not a whole lot of Fed news per se that the market has to adjust to. It has more to do with events that are happening this week, as we're fully priced in for what to expect from the Fed next week.
Subhadra, how do you think investors would internalize a potential rapid slowdown in the Chinese economy, something that perhaps we didn't expect 3-4 months ago, and maybe even a 3 handle on Chinese GDP? How do you think they'll express that in a Treasury market with the Federal Reserve determined to hike interest rates?
That's a very good question, because it's a very, very difficult needle to thread for the Fed, because on one hand, they want to raise rates to fight inflation, but a slowdown in growth is going to be very, very impactful, especially a country like China. If you're going to see a meaningful slowdown in growth there, it's going to reverberate through the rest of the world. Yes, for the most part, the U.S. tends to be somewhat isolated. I think the impact is going to be much more felt in Europe. But broadly speaking, I think that if there's a meaningful slowdown in growth in China, that's going to be a concern for the U.S. And that's kind of what is already in the price. If you look at the flatness of the curve, the market's really concerned about a stagflationary environment where the Fed has to raise rates and push front-end yields higher, but that growth might ultimately falter. And that's really where the difficulty comes when the Fed starts to think about adjusting monetary policy. That's why I think that they might raise rates up to or close to neutral, but it's going to be really hard to go well beyond that this year.
You used the N word. What is neutral, Subhadra?
Well, the Fed's expectations of neutral is around maybe 2.25 or 2.5%. I think getting there by the end of the year is going to be pretty challenging. They might be able to deliver 50 basis points rate hikes in the next couple of meetings, but beyond that, really the trajectory for growth is what's going to dictate if the Fed's going to be able to continue to raise rates aggressively, especially given the fact that they're going to be unwinding their balance sheet quite aggressively as well during that time frame.
Subhadra, we're talking a lot about Asian currencies really losing value, and we're watching the yuan today not really gain back or pair some of those declines, even in the face of further easing by the People's Bank of China. We talked about the Japanese yen depreciating and how that would influence Treasury yields, that it could lead to a lack of buyers from Japan into the U.S. market. How much is that an unintended consequence of some of the currency moves that you might get some investors seeing more value at home on a currency-adjusted basis because of what we're seeing in the dollar?
Well, I think that is an important consideration. I mean, throughout the course of this year, I would say that treasuries haven't looked attractive to Japanese investors on a currency-adjusted basis. But what I'm more concerned about is yield curve control. I mean, you're starting to see the weakening of the yen. You're starting to see the market push back on yield curve control. If Japan were to, make any adjustments or sort of step away from its easy monetary policy stance, and if long end JGB yields start to rise on the back of that, then that could be the catalyst for higher yields in the U.S. It doesn't have to be necessarily capped by demand coming from from overseas accounts, but if global bond yields continue to rise, that's going to push Treasury yields higher as well.
Subhadra, I did something this morning. I can't remember the last time I did this, folks. I believe I had no gray hair. I looked at the Bloomberg Total Return Indexes, Subhadra, over full faith in corporate credit rather, and the high yield. And these are, bear market statistics. Does your world understand they're in a bond bear market?
So it's interesting that you bring that up, because last week we kind of sat down and looked at returns in a variety of assets, not just bonds. But equities are also down 10%, bonds are down 10% year to date. So in some respects, you're looking at investors, maybe the best trade to do for investors is to move into cash, because returns across the board are looking weak, not just in bonds, but also in risky assets. So this is sort of a transitionary phase to sort of figure out what the Fed is going to do, where the market's going to settle in. So I think the near-term strategy should be towards perhaps moving some of your holdings into cash, because you're going to see negative returns across the board in risky assets as well as in treasuries.
Subhadra Rajappa of SocGen. Subhadra, a great time to catch up with you this morning, given what's taking place in China. What on earth does that mean for this treasury market with the Federal Reserve determined to hike interest rates? Over the weekend, Tom, on credit, Vishy Tripatur of Morgan Stanley, up in quality. The emphasis from them.
I read every bit of that note. It was interesting to see Wilson come out and Tripatur come out for the same shop and really dovetail on where we are. And they use this word, John, relative. Relative to what? And what's interesting, in a bear market, all of a sudden relative analysis becomes absolute analysis, which is OMG analysis, like OMG, I'm down that much. And it sort of goes on, and Vishy, I thought, was really quite good about that.
Well, in stocks with Mike Wilson, I think what he's talking about now is, yes, you can get some relative outperformance in an absolute down market, but what he's looking for now is some real pain at the index level, and that's the bear market you've been talking about, Tom, through this morning. On the credit side, where Morgan Stanley was interesting is that they were okay with credit. They were okay with default risks. They thought that this year was good enough. Be overweight the credit story in some way, shape or form. And the way they were doing that, Lisa, was just through leverage loans. Leverage loans over high yield. The rate story pays into the leverage loan story, but ultimately they're okay with credit, so take that risk. And that's a preference they've closed out over the weekend, and that's probably the key move.
It's key because we talked about interest rate versus corporate credit risk, right? And they were saying that really the pain has come from a resetting of the Fed expectations of how high rates could go and how high inflation could go, not based on the idea that companies would default in the near term. Default rates are still very low. That has changed, not necessarily that they see defaults surging, but that they see that basically the interest rate story has been baked in. People have gotten a sense of what the Fed is going to do. Now we're going to talk about a slowdown, and that has to reset some of the corporate creditworthiness that we see right now.
I heard the same thing from Goldman. I caught up with their head credit strategist at the end of last week, and he was talking about the same thing, that we've seen the cyclical peak in credit quality, and they're looking for that same up in quality story. Twitter, the main event in the equity market this morning, up by about 5% in the pre-market off the back of our story, suggesting that we could have a deal between Twitter's board and Elon Musk, Tom Keene, as soon as today.
I've never looked at his Twitter feed, John. He's got more followers than you. I had no idea. 83 million followers.
He's got things to say, Tom, about a range of issues.
He's got a retweet on SpaceX.
Yeah.
And, you know.
Is there something else you want to bring up? Or
he's got a thing on. You guys were talking about Bill Gates. I missed that story this weekend.
And so he's going to describe this.
Are you going to describe that tweet?
Let's not.
I thank you, Lisa.
I'm just going to give you an out.
I believe Mom just spoke.
The picture of Tom Keene in the evening after a long meal.
My word.
Really?
And a lot of drinking.
Really?
Yeah, perhaps.
Did you hear that Mom, let's not? It was a certain tone from the kitchen.
That resonates.
Let's not.
51.25 at a pre-market on Twitter.
Let's not.
The offer price, 54.20.
John,
New
let's
York.
quote the Dow.
Let's not.
Let's not.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned that Twitter is on track to reach a deal with Elon Musk on that $43 billion takeover offer as early as today. Still, the talks are said to be fluid and a deal could be delayed or fall apart. Twitter had previously considered thwarting that Musk attempt. U.S. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin met with Ukraine's President Volodymyr Zelensky in Kyiv Sunday night. It was the highest-level U.S. visit since Russia invaded 2 months ago. The U.S. promised Ukraine more military aid, and Austin said that Washington wants to see Russian forces ground down so they can't attempt a repeat of the war. In France, voters have given President Emmanuel Macron a second term. Macron turned back nationalist rival Marine Le Pen in Sunday's runoff, winning more than 58% of the vote, but his 17-point margin was barely more than half what it was back in 2017, and many voted for Macron just to keep Le Pen out, rather than because they're enthusiastic about Macron's pro-business, pro-European vision. And in China, the coronavirus outbreak has gotten worse. A rising number of cases in Beijing has sparked jitters about an unprecedented lockdown of the capital. Policymakers are trying to avert a Shanghai-style crisis that has already wreaked havoc on that city. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I believe that we share the same resolve, which is to tame inflation, which is to use all the tools that we have to do so. But we're facing a different beast.
Christine Lagarde, the ECB president, on CBS. And Europe is facing a different beast. They are way more exposed to what's happening in China relative to the United States. And there is a slowdown building in China with the potential of lockdown spreading from Shanghai to Beijing. That shakes things up at a Chinese equity market, shakes things up stateside too. We're 0.8% lower on the S&P. We're down by 0.9 on the Nasdaq 100. This month has been absolutely brutal for the Nasdaq 100. Big story in the pre-market is Twitter, up by more than 5% in the pre-market at 51.70. Did trade at 52 very, very briefly, came close to that level, then backed away. 54.20 the offer price from Elon Musk. Tesla a little bit lower off the back of some of this, down by more than 3 percentage points. As we report today, Tom, that we could reach a deal as soon as today.
Yeah, well, that's out there. And I would suggest, John, that markdown from 54 down to, call it 52 or just under 52 is about normal. There's always, John, a little bit of squishiness there.
Came very close to 52 at 51.98, I think, at the highs. Closing this one up is going to be very interesting, Tom. I'm fascinated to see if he can close the deal, one, and two, what he's going to do with it.
We're going to talk to experts on this. Michael Nathanson's scheduled on our date calendar here somewhere in surveillance this morning. Right now on China and the challenges there. Kriti Gupta.
Yeah, Tom, we got to talk about this potential for a Beijing lockdown. At least that's the fears that are driving the sell-off this morning, not only in China markets and Asian markets overnight, but also here in the States and across commodity markets as well, as John mentioned. Something to keep in mind, though, is what this is doing to the actual stock market. How cheap is cheap enough? Is this enough to buy the dip? And that really brings me to my chart of the day here. We're looking at the MSCI China Index going all the way back to 2007, and we're looking at their PE ratio. Now, we're doing something a little fancy here, and we're using standard deviations. The PE ratio has now dropped 1 standard deviation. It speaks to just how much weakness is in the stock market all morning long. Surveillance has been talking about the weakness in the offshore renminbi, but also you had Jens Nordvig earlier in the show talk about simply mobility data, the concern about exports when it comes to China, and that's really being reflected when you look at the cheapness of this market. Is it enough to catch that bid? And right now, with this fear of the Beijing lockdown, it doesn't look like it is.
Kriti, thank you so much. And of course, what's interesting here, folks, is the effect in each nation, the path to treating this pandemic. Joshua Sharfstein joins us now, Vice Dean of Johns Hopkins Bloomberg School of Public Health. Of course, Mr. Bloomberg, a nodding acquaintance with his television and radio property as well. Dr. Sharfstein, we are under 400 deaths. That is a triumph to people like you and your team at Johns Hopkins. I calculate flu on 50,000 deaths is 137 deaths per day. Do you assume that we're on a migration to a flu-like statistic?
We could be. We could be. I think that's exciting. Of course, we are seeing hospitalizations starting to creep up in this country. And with that, deaths will probably turn around too and start to go up. I think that is from this BA2 variant. So I don't think we're on a one-way path to the low 100s, but it's possible that we could get there. A lot depends on the virus and a lot depends on us.
Dr. Sharfstein, how do you understand what's going on over in China, the fact that they're not moving away from COVID-0? They're talking about deaths, and they're talking about trying to contain the spread of something that we all know seems something uncontainable once Omicron came into the picture.
Well, what's very interesting is that in our country, we have a lot of people unvaccinated. They tend to be younger. Our highest vaccination rates are among the elderly. That's the opposite in China. In China, some of the lowest vaccination rates are among the elderly. And they, of course, are very susceptible to severe illness. And as well, they haven't, even those who have been vaccinated or just one shot, it's not necessarily the best vaccines. So they have a lot of vulnerability there. But having said that, I can't argue with you that they're between a rock and a hard place because, locking down an entire country of so many people to prevent the spread of a virus that's incredibly infectious, it's a battle that's very difficult to win.
Dr. Sharfstein, based on your experience, how much of a vulnerability is it when you put that kind of strain on a healthcare system with isolating people who might not be mortally ill because they have COVID at a time when there are people with other problems? I mean, do we have a sense of what the non-COVID mortality rate is when you put that kind of stress on a healthcare system?
Well, I think what they're doing right now is they're not stressing the healthcare system. They're trying to keep the virus from spreading so that they don't have so many patients, and perhaps they're concerned that they don't have the healthcare system to take care of it. But you're right, by, those kinds of extreme measures, there are all kinds of consequences. You're talking a lot about the economic consequences, but the mental health consequences, the other health consequences are pretty severe. And, it eventually just can't continue this way because the virus is always going to be out there. So they will be in this perpetual state. And, so something has to give, and we're just going to have to see what happens.
Joshua Sharfstein of Johns Hopkins Bloomberg School of Public Health. Joshua, great to catch up with you, sir. So much going on this morning. Just to kind of process what's happening in China is a big, big effort. Then the Twitter story overlaid on top of everything else. Let's look at Twitter in the pre-market. A shift higher, the stock of 51.70, up by more than 5 percentage points. Reporting over the weekend started with the Wall Street Journal that Elon Musk was meeting with Twitter executives. Reporting from us this morning suggesting we could reach a deal as soon as today. Then backed up by reporting from Reuters that Twitter is set to accept Musk's best and final offer, according to sources. And that best and final is 54.20, and this is about as close as we've come to it so far. 51.98 earlier on in the session, Tom.
John, I go to price to sales again, and let's look at it. This is just really rough off the Bloomberg. We've got a lot of moving targets here right now, but let's call it Twitter 8 times. That's a rich valuation. Snap, John, I thought Snap was Snap-on Tools. I got that wrong. Snap, 10, maybe 11 price to sales, just really, really huge valuation. And in Facebook, Meta, John, is 4 times sales, 5 times sales. I mean, this is a rich valuation for Twitter on acquisition, given where Instagram is.
And clearly there was a shift over the last week where the board started to take things a little bit more seriously, Lisa, as we got more and more detail about the financing behind Elon Musk's offer.
If they're bringing in the big behemoth investors of Wall Street into the deal, they believe that we do not necessarily have a rogue actor in Elon Musk who simply wants to use Twitter as a mouthpiece or a vanity project. It has to be something more. If you're dealing with some of these players, what I find interesting is if they see top value in $54.20 without negotiating further, what does that mean in terms of the deal that other Wall Street investors are getting? How did he convince them that that was the right price target for something that seems fairly unquantifiable right now?
Well, it's the only offer on the table right now, isn't it? And I guess that helps to some degree. Did they think people would come in and make a similar offer? Something bigger?
Honestly, given the fact that we were talking about how every tech company wanted a media platform, why not? There are plenty of them with plenty of cash to spend. The fact that there were no other bidders that came in tells you a lot too, John, especially given the fact that they're considering so closely this offer after saying they were going to fight it, and it was a hostile takeover.
How many big tech companies do you think there are that can actually close that deal and get past the regulator?
Oh, that's a fair point. I guess that's
Elon
true.
Musk flying solo with an offer of 54.20. I am fascinated by this story to see what he does with this company if he can close it. Futures are negative 0.8% on the S&P, on the Nasdaq down by 0.9%. From New York City this morning, good morning to you all. The situation in China shaking up this market worldwide.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think we're going to end up living with more inflation.
The lesson here is stagflation has two parts of it. You've got to focus on the stagnation as well as the inflation.
Many consumers are going to really falter even further under the weight of what is likely to be more interest rate hikes.
The Fed has the courage to act, and I don't think the market should take comfort in that.
This is still an economy that's operating above trend that can be resilient to some shocks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you to Markets on the Move. Yes, it's about a follow-on from what we saw Friday afternoon, Dow down 900 points, and on we go. China front and center in the story. But, John, corporations continue to move forward with transactions and combinations. Mr. Musk front and center this morning.
Yeah, the offer from Mr. Musk. Elon Musk is 54.20, and Twitter in the pre-market trading pretty close to it, as all reports suggest we could, I stress could, emphasize could, have a deal as soon as today, Tom.
I can't emphasize enough, John, in all the reporting over the weekend, the single sentence, I'm going to give Bloomberg credit for this, but it may go to others as well. Morgan Stanley steps in some way to assist here. There's a difference, John, between Mr. Musk alone and Mr. Musk with Wall Street.
And it's not just Morgan Stanley. It was MUFG, it was Bank of America, Mizuho, BNP, SocGen, Barclays, a whole range of banks backing up Elon Musk's offer, Tom. And that's clearly what changed things for this board, taking that offer seriously. At the time when it came out, 54.20, the joke's about 420 and whether this was serious or not. Once you get Wall Street involved, once you secure those letters, Tom, and you throw them over to the board, that's when the board takes things a whole lot more seriously.
Michael Nathanson will brief us on this in this hour. We're thrilled by his attendance. John, we've got to look at everything else as well. Some catharsis, to say the least, Friday afternoon.
Yeah, this for me, Tom, over the weekend continues, and it really, really bleeds into what's happening with China. It starts with Shanghai and lockdowns, bleeds into Beijing. It shakes things up in that equity market. The Shanghai comp down by more than 5%. European equities struggle. The NASDAQ struggles. The NASDAQ this month is down 10%. That is a monster move. The biggest move we've seen on a monthly basis going back to 2008. And this week for big tech, what a week we've got coming up for those earnings.
Those earnings on the back end, including, I believe, Apple on Thursday. Thursday. Lisa Bramlett, all of this we touched upon in Washington at the IMF about global slowdown led by a fragile China.
And that really has been the dominant story until Twitter came into the sphere this morning. But how much does that really change the backdrop in a dramatic way? And for Europe in particular, I think this is important because we were expecting euro strength this morning after the Macron win in France. It is not strength. It is weakness versus the dollar. And that's just dollar strength. Everything else weakness that's really dominating across the board, Tom.
Yeah, we see it in the other. We'll have Nathanson on here on entertainment. Netflix, John, hasn't found a bid yet, really, has it?
Hey, well, that's been a struggle, hasn't it, Tom?
There's been a few other stories as well. On the data front, John, I'm going to suggest, John, a more constructive tape than what we saw an hour ago.
Well, we're still down and down hard on the S&P and the Nasdaq 100, down 0.9%. Crude is lower by more than 5% now. We have a 96 handle on WTI. Really speaks to that slowdown story out of China.
Yeah.
Yields lower too by 9 basis points, 281, Tom, on a 10-year.
We'll have much more for you in the hour. Just a lot of news flow this morning. Let's get right to a guest here as we wait for Mr. Nathanson. Gene Tenuzzo joins us, Global Head of Fixed Income at Columbia Threadneedle. I called it Recalibrate Monday. I guess everyone's recalibrating, Gene, particularly Mr. Musk. How do you recalibrate in fixed income after the April we've enjoyed?
Well, enjoyed is a strong term for those in the bond market, Tom. It's been a pretty volatile year, and recalibration, I think, really is the right word. We've been recalibrating Fed expectations all year long, and now we sit at a point where we're pricing the Fed to get above its own estimate of neutral pretty soon here. So I think it puts a risk premium in the market that when you have periods of volatility coming from places like China, like we see today, you have an opportunity for bonds to act like that diversifier that we haven't had in a while.
Well, Gene, let's take the China story. That's the knee-jerk move this morning. Treasury's doing well, firmer, yields lower. How do you expect to see investors express that slowdown in China in this Treasury market?
Well, there are a couple of ways, John, that plays through. The first is, this is a commodity negative shock. So we're seeing that play through the system, in the very short run. That may take just a little bit of pressure off the Fed, who was probably getting a little hot around the collar when you look at 10-year break-even inflation in the U.S. over 3% as recently as the end of last week. So I think that's one. The second is a tightening of financial conditions. You just mentioned the NASDAQ being down over 10%. We're starting to see the combination of tightening financial conditions start to bleed into early indicators of economic activity. So I think we're starting to see the brakes on the economy that the Fed has been trying to put on really start to show some deceleration.
Gene, when you say that it might take some of the heat off the Fed, it implies that perhaps they are looking for a reason not to hike as much as some people might be suggesting. And I am reading into what you're saying, but I'm doing it deliberately because what we are seeing in the market is a disbelief that the Fed will go as quickly enough as perhaps would be necessary to bring down longer-term inflation to the 2% level that the Fed has traditionally targeted. Is that your view, that basically the Fed is going to look for off-ramps to not go as quickly as the market is saying you have to go in order to curtail inflation?
Eventually, but I think we have a long way to go before they're looking for an off-ramp, Lisa. We're looking at a couple of 50 basis point hikes here over the next 2 months. It's going to take the Fed funds rate to the mid 1% area. Maybe when we get to late summer, early fall, we'll be looking for some opportunity to decelerate, but I still wouldn't call it an off-ramp. We're going to see the Fed funds rate, approaching 3%, if not higher, by this time next year. And I think that's where you start to get a much more inverted yield curve, not the modest inversion that we've seen so far.
So do you think that interest rate risk is already priced in? That was what we heard from Morgan Stanley, saying that, frankly, the concern and the sell-off that we saw driven by interest rates earlier is going to shift to a concern about the credit worthiness of companies that are going to be facing the slowdown that a lot of people are talking about.
I think eventually that will be true, but it's too soon to say that. The Fed's only hiked 25 basis points so far, and companies are in a really good place. Balance sheets are strong, and we look at margins and measures of profitability and leverage, and they're better than they were in 2019. So it's not going to be a month or a quarter that weakens that narrative, but as we move into 2023, that could start to change. And I think, you start to look at a long Treasury yield of near 3% or over 3% on some maturities. And that starts to look cheap relative to the Fed's long run expectation of 2.4%.
Gene, what are people doing with their money? We have an intuitive understanding in the equity markets, stocks south, go to cash. What do people do in your world when price goes down?
Well, I think the knee-jerk reaction is a little bit of sticker shock, a little bit of sort of alligator arms, not particularly comfortable putting money in the market right away. But what we've seen is the larger institutional investors really have started to move back into this market, particularly as you could build portfolios of high-quality bonds with a 4 to 5% yield. And I think that's really the theme here, is that in the bond market, quality is on sale. That's what we're seeing, looking at investment-grade corporate bonds, looking at municipal bonds. High-quality sources of income are as cheap as they've been really in the last decade. And so, this is an opportunity we've been waiting for. It certainly comes amidst uncertainty around inflation, uncertainty around Fed policy, but that's the way the market works.
Gene Tenuto of Columbia Threadneedle. Gene, thank you, buddy, as always. If you missed the Bramo column over the weekend, well worth the read. That's the story for me as well in fixed income. Barclays spoke to this last week, Lisa, when they said the following, that the Fed has emphasized they are largely content with hiking to neutral, perhaps a bit above. And to your point in your piece, this is what they said about it. Investors are interpreting the Fed's strong desire for a soft landing, which Chair Powell described as a goal, as signaling greater comfort with above-target inflation for longer. And that, Lisa, which is the heart of your piece, is what the bond market, seems to be picking up on.
Absolutely. Even today, when we see a bit of a bid into the Treasury market, you're not seeing a commensurate move when you look at the expectation for inflation over the next 5 to 10 years. It still is hovering at the highest levels going back to 2014 at 2.56%. So just to give you a sense, people are thinking that perhaps the Fed is going to err on the side of not hiking as much, which is going to lead to a prolonged bout of higher than average inflation over the past couple of decades.
It's something you've been discussing, Tom, pushing this story out to 2023.
The timeline goes out. Yeah, I think that's really important. And also, John, it's about how far they go. To the point of Lisa's essay, Dominic Constant publishes at Mizuho moments ago, and he says, look, the summary here is a possibility of a Fed where the bark is worse than the bite. And that's this idea of not having the pendulum extend out to true restriction, but some form of neutrality. And there's a whole group of people, John, that don't even think we get to neutrality. They just go along the way. Priya Misra, I think, is in that camp of just, we get along.
Well, to Lisa's point, there's been a lot of barking and not much biting so far. You can read the column on Bloomberg.com and, of course, on a Bloomberg Terminal too. As always, Bramo, I'm happy to promo the piece. Futures are down on the S&P by 0.8%. In the pre-market, there's one stock to watch, and we're going to be talking about it in just a moment. Twitter up by more than 5%. Let's call it 51.50. Tom Keene just moments away from catching up with Michael Nathanson of MoffettNathanson.
Well, it's not only Twitter, but it's also the entertainment sphere that he works in. Yes, Twitter's front and center, but John, these erosions in some of these stocks, Netflix and Warner Brothers Discovery printing under 20 pre-market. These are real markdowns in the Nathanson world.
It was very tough for Netflix last week. It's been tough for the whole of the NASDAQ 100 through much of the last month. We've talked a lot about that move lower on the NASDAQ 100 by almost 10%. In fact, make it 10% by the time we open up this morning, with NASDAQ 100 futures down 0.8% and the S&P 500 negative 0.75%. We'll be talking about Twitter in just a moment with Michael Nathanson of MoffettNathanson. What this means for Tesla as well. Twitter firmer in early trading. Tesla a whole lot softer. From New York City with Tom Keene, Lisa Abramowitz and Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It could be one of the biggest internet acquisitions ever. Bloomberg's learned that Twitter is in the final stretch of negotiations about a $43 billion sale to Elon Musk. An agreement could be reached as soon as today if negotiations go smoothly. Musk met with Twitter executives Sunday. The company started warming up to a potential deal after Musk revealed a financing plan. It is the highest level U.S. visit to Ukraine since Russia's invasion. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin met with Ukraine's President Volodymyr Zelensky in Kyiv late Sunday night and promised more military aid. The U.S. also says it would start sending diplomats back to Ukraine. In France, Emmanuel Macron has won another shot at convincing the public that his pro-business, pro-European vision can work for them. Macron won a second term as president, beating nationalist Marine Le Pen with more than 58% of the votes. Macron acknowledged that much of his support came from people who don't support his ideas but wanted to keep Le Pen from winning. And the price of oil fell below $100 a barrel on concerns that the spreading coronavirus outbreak in China will hurt global demand. WTI futures fell almost 5%. China's demand for gasoline, diesel, and aviation fuel this month is expected to fall 20% from a year ago. And Coca-Cola reported fourth quarter sales and profit that beat estimates. Consumers returned to much of their pre-pandemic behavior, and the world's largest beverage company emerged from a long period of shuttered venues. Coke reaffirmed its guidance for full-year growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I do think this will be somewhat painful, and I'm not sure that I will actually be able to acquire it. And I should also say the intent is to retain as many shareholders as is allowed by the law in a private company.
That was Elon Musk speaking at a TED Talk just a week and a half ago. Elon Musk in the news again this morning. We are reporting here at Bloomberg that Twitter and Elon Musk are closing on a deal which could be announced as soon as today. The stock is up by 4.5%. Some additional reporting in the last couple of moments that Elon Musk is said to be lining up equity partners for his Twitter bid. The talks continue with other potential co-investors. The stock at 51.15, the offer price 54.20. That's the move, Tom.
I'm in absolute silence, John, over where it is. There are others out there that have published on this, John, and we go to the experts, Craig Moffett and Michael Nathanson, joining us now, someone who has followed content, the kings, the queens, the princes for decades. Mr. Nathanson, I'm going to go to a price-to-sales analysis. You got to be kidding me. I'm modeling 7-8 times price-to-sales. That seems a tad rich.
Yeah, Tom, it's a tad rich. If it wasn't for this bid, the stock would be down about 40-50%. Their peak earnings at Twitter were in 2018. We think their margins this year, profit margins, will be close to zero. This is a gift, right? It just is a gift. And we said take the money and run. We've been saying that a lot. Just take the money and run. Because there's no other bid coming after this.
Michael, what do you say back to people who said, well, wait, this stock traded in the 70s 12 months ago. Why are we selling this at 54.20?
Because that was a bubble, right, John? Netflix traded at 700, Roku was at 400. That was a bubble. And it made no sense then, and this price makes no sense now if it wasn't a bid.
Michael, why then are other investors on Wall Street getting involved with Elon Musk at this price target?
Because he's made money for everyone, right? He's basically someone you want to bet on, and if you're in the stock already, why not? If you could let it ride with Elon Musk, why not, right? Basically, he's not laid out his plans for a turnaround, except for his views on his free speech, right? So we don't know what he's going to do on the cost structure. You don't know who he's going to bring in there to run the company, right? Betting on Elon Musk has been a good bet for everyone, so why not continue with that bet?
Michael, is this a media company or is this going to be an advertising-based revenue structure similar to what we see in Facebook and others that really will be the driving factor that you believe could make this a little bit more profitable?
What's interesting is we've talked a lot about a subscription model here, and I think there's traction, right? If I don't want the advertisements, if I want to basically select, who I want to pay attention to and get news feed, live breaking stories from, there's a subscription model. Maybe you're going to have what you've seen in media now. You have an ad tier, and you have a subscription tier. And I would think at some point they move to that. That would make sense to me.
Michael, I know you've seen Barbarians at the Gate 14 times, and you know what it's like.
I have it behind me somewhere.
To be honest, folks, the fancy bankers, the smooth guys out in Menlo Park, they all read Michael Nathanson cover to cover. What has changed in the last 48 hours when we see Morgan Stanley and other legit bankers are involved in this process? What does it mean when the Barbarians are ready to tweet?
It means that there are not a lot of great ideas right now on the banking side, right? This is a big idea. You help Elon Musk achieve his goals, and then you tag along for wherever he does next, right? Maybe he'll buy some other assets. Maybe he'll bring this thing back public.
I don't mean to interrupt, but did they get equity in a private institution, as Mr. Musk alluded at that TED Talk?
I would think you tag along, right, Tom? Who would ever think that Tesla would be worth what it is today, and he'd be able to achieve what he's done
John
with SpaceX?
Farrell, he's the only one that got it right.
I don't know about that. Michael, I'm thinking about a future platform and whether advertisers want to be a part of that. We know about this increasingly progressive view of multinationals. Let's take, say, the Walt Disney Company that falls under your coverage. As they shift to a more aggressive freedom of speech model at Twitter under, say, Elon Musk, how do you think multinationals will view that platform as maybe somewhere they want to advertise?
No, John, it's a great question. I think it's a major, major problem. We've been writing for the longest time, really since 2016, that social media has major content quality issues, right? So if you pretty much take away all the moderation that Twitter's put in, that Facebook has put in, it's going to make advertisers much less willing to participate, right? They're not going to want to be stuck in content that they deem is is not quality or safe. So I think it's a major problem. It's not going to be the market's problem, and then if they can move to a subscription model, drop the advertising, move there. But John, that's a huge issue, and that's something that Twitter's been trying to clean up, and it's a risk to the monetization in the next couple of years if that's what happens.
So help me understand your buy on Facebook, Meta platforms, with everything we've just talked about, because they're reporting later this week.
Oh, yeah. It's been a tough place for us to be. But Facebook has made their business based on targeted performance-based advertising. Even with all these Apple changes, they still have really strong first-party data on who you are, Tom, Lisa. They're able to target you in a way that Twitter has never been able to. So our bets on the long-term opportunity that is targeting advertising online, and Facebook has a dominant position there, right? And there's been a bit of a headwind lately, either from IDFA, from macro, from the movement to Reels. I feel really good about where Facebook is in the next 12 months. But they're in a different business than where Twitter is. Twitter's all brand advertising.
Michael, you and Craig Moffat have had a week to digest Netflix and the other foolishness out there. Have we seen a true structural shift in the streaming game?
I think we've seen a true structural shift in the investors' willingness to pay 5 years out for the streaming game. I think we've seen investors realizing you can't pay for revenue multiples, you have to pay for earnings. And then in terms of the shift, you've asked me over and over, Tom, about is this a good model? Where's the top on spending? Netflix is telling you that they can't spend as much going forward, right? That's an opportunity for others to catch up to them, right? So it's really interesting. I would argue that the people who've lagged behind now have an open door to compete with Netflix on their own terms, right? That's advertising, it's sports, it's more theatrical films. It's an opening. It doesn't mean this is a great business for anyone, but it means that the playing field is going to be more level than people thought about a week ago.
Michael, just fascinating stuff. Michael Nathanson there of MoffettNathanson. Michael, we appreciate your time, buddy, as always. To call it a bubble, hey? The move in Twitter last year, that was a bubble.
Well,
Lisa, Roku, that was a bubble. The view of, say, Mr. Nathanson of MoffettNathanson this morning.
I loved when I asked him before the segment. I said, "Are you surprised that no other bidders have gotten in?" He said, "Not at all. This is a gift from heaven." He repeated that kind of phrase. The fact that there are other investors in this really speaks to Elon Musk's ability to wrangle support from investors, because right now the model does not suggest exactly the value.
Well, look what he's achieved with Tesla.
Yeah.
What an achievement.
Absolutely.
Against all the naysayers. And that's why many people, TK, don't want to bet against him right now.
Yeah, I'll go there, absolutely. And let's not forget PayPal. I mean, the guy has a track record going of getting things done. Everybody's focused on the politics and the Bill Gates stuff and that. What if this guy financially stabilizes Twitter growth?
He's got a track record, as you point out, Tom, going back decades.
Yeah.
The offer, 54.20 in the pre-market Twitter.
Should I tweet on the break?
Just short of that. Go for it, TK.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flights to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Monday morning, brand new trading week, and we are hitting the ground running live on TV and radio. This is Bloomberg Surveillance, and here's your price action. Aggressively lower in China, down by more than 5% on the Shanghai Comp. Equities lower in Europe, lower stateside too. The tape improves just a little bit. Off the lows on the Nasdaq, we're down 0.6%. On the S&P, we're also down 0.6%. Concerns about lockdowns spreading from, say, Shanghai to Beijing, sending yields lower on a 10-year by 7 or 8 basis points in the Treasury market to 282 on crude, down by almost 5%. Had a little look at a 96 handle. Now, Tom, 97.27.
Absolutely, John. There's a headline out. This alludes back to the conversation with John Gray the other day. Blackstone to buy PS Business Parks for $7.6 billion. It just doesn't end, John, does it?
Deal makers are doing what deal makers do. They're making deals, Tom. Elon Musk is a deal maker as well.
Yeah.
Apparently, the offer is $54.20 in the pre-market. The stock is higher. There is a conversation about a deal getting done as soon as today, potentially, according to our reporting. And he's still looking for co-investors. That stock, Tom, trading higher in early trading.
28 million square feet on PS Business Parks. I agree, John. Deal makers are doing what they do. They keep going. As economists do what they do, just keep gaming.
Can you do that again?
Do what?
Do the square footage on PS Parks.
There's 28 million total square feet.
No, just with the voice.
No, I can't.
You can't do that again.
I can only do that once a day.
Worries.
Andrew Hollenhorst will save us, chief U.S. economist at Citigroup, who turned American economics on its ear with a call. There's the beverage curve at LSE. There's the Phillips curve at LSE. And now there's the acclaimed Hollenhorst curve, which is a certain number of interest rate increases. Where in the Hollenhorst curve does Mr. Powell become restrictive?
Yeah, great question, Tom. Yeah, and thanks for having me on. I think that's what we're seeing is Fed officials trying to find where that restrictive point is. We've definitely had a very concerted pivot, shift, lean towards the hawkish direction as inflation continues to run strong, and you're looking for a point where the economy slows down. So we have mortgage rates that are significantly higher now, up above 5% on a 30-year fixed rate mortgage. Maybe that's going to slow down the housing market. But the jobs market, that's really where I would look at the end of the day. Still about 2 job openings for every unemployed individual, maybe needing a lot of restriction to slow the economy down enough to kind of take away that inflationary pressure.
Andrew, what's the data point of the week for you? The employment cost index?
Absolutely. Employment cost index. I think this was a data point for Q4. If you remember back at the end of last year when Chair Powell looked at the data, Fed officials looked at the data, and we started to have this concerted movement towards more hawkish rhetoric from Fed officials, dots indicating the appropriate level of policy rates that were moving higher. It was that broad-based wage pressure, because that's the fundamental supply-demand imbalance in the economy right now. If you have a shortage of workers, you'll keep pushing up wages. If wages keep pushing up, then you'll have this kind of spiral of rising wages and rising prices, which we're in the very early stages of now. So that's the key number this Friday.
Andrew, where is the asymmetry of risk then, given that ECI, the Employment Cost Index, when it comes out? Is it that it will actually come in hotter than expected or actually weaker than expected in terms of how the Fed will respond?
Yeah, I think that's right, Lisa, that it's really hotter than expected where the risks lie. If you look at some of the underlying data, what's going on with wages, the Atlanta Fed has what they call the wage tracker, and that controls for a bunch of characteristics of workers. That is really picked up in recent months. So you're seeing this kind of broad-based wage pressure. It should come through in the employment cost index. What we get in the cost index is not just wages, but also the benefits. And I think that's where maybe we're seeing some of the increases around the edges, where some firms are reluctant to increase the wage rate, but are increasing other benefits. So all of those things create some upside risk to the employment cost index, and that's, of course, risk to a more hawkish Fed policy.
So, Andrew, I'm really trying to get my head around this idea of peak hawkishness, which a lot of people were talking about a couple of weeks ago, and then it got even more peaky and more hawkish the following week. I mean, can we get to a point where we're talking about a Bill Dudley-esque 4% Fed funds rate if the ECI comes in as hot as you expect, or as we start to see some of these other indicators really support that view?
Yeah, that's right, Lisa. I mean, if you look at where inflation is running now, it wouldn't be that extreme to think that policy rates could get upwards to something like 4%. In our forecast, we have them going above 3.5% next year. Now, the market is not fully pricing that yet. And I think, to your point, we need to see more evidence that inflation continues to run strong. The other aspect is how much have financial conditions tightened? So, we were talking about mortgage rates that have moved higher. That's a tightening of financial conditions. Equity prices that are lower this morning, that's a tightening of financial conditions also. And that's what the Fed kind of has to figure out here, is how far do you need to push expectations of policy rates to get financial conditions tight enough to slow down the economy?
Andrew, how much will trade play into this? I'm really quite taken by the IMF World Economic Outlook of global trade slowdown. How much will that pair off U.S. GDP and fold right into the Fed discussion?
So I think there's a GDP component here, and there's also an inflation component. And in the short run, we have a lot of supply chain issues, and that's impacting GDP. We see that in auto sales, for instance, that have been weak. But if you think of the longer term implications, if we have a movement away from globalization towards regionalization, towards re-onshoring, essentially you're moving away from lower costs of production technologies to higher costs of production technologies, almost by definition, because the reason that globalization occurred was to find the low-cost producer. So that kind of global downshift, downwind, disinflationary force from goods prices, that's not going to be there in the same way.
So are you suggesting we stand alone? I mean, I'm calling it Recalibrate Monday. And do we have to recalibrate to a new aloneness of the American economy?
I think trade will always be part of the economy. I mean, it's not that there will be a kind of full shift away from trade, but do we need to recalibrate to a world where there's less diversity or less global downward pressure on prices? I think that is the case.
Andrew, market pricing has followed you. You've not followed market pricing, and sometimes that's original. And that's not snarky, that's just the truth. Often what happens is you get strategists and economists marking to market. Andrew, that's not what you've done. You came out a month ago and looked for 4 50 basis point interest rate hikes in a row. 50 after 50 after 50 after 50. That was March 25th. A month later, it's consensus, Andrew, and it's largely priced. Can you tell me what guided you into that effort, one? And two, why you're convinced that this Federal Reserve will not only go to what they think is neutral, that they'll go beyond that? Because for me, that's the debate right now, many people doubt they'll take that next step beyond neutral. They're looking at the Fed speak and looking for confusion. They're saying that there's not much appetite to go much beyond that. So tell me, one, what guided you to your big call that's now consensus? And two, what's guiding you to believe that they will go beyond what they think is neutral?
Yeah, thanks, Sean. Yeah, what we always start with are the fundamentals. And so the number one driver of that hawkish Fed call was what our call was on inflation. We saw persistent inflationary pressure. We saw inflation that was going to continue to deliver well above target. And the analysis there was, well, if you have inflation that's delivering well above target, and there's nothing organic that's going to bring it down. I think that's where we differed with some other forecasts that, supply chains were going to normalize or there'd be enough of an increase in labor supply. We saw nothing organic in the economy that was going to bring down inflation. So that means that the Fed needs to fight inflation. And then you go to number two, which is the need to get interest rates to at least neutral, if not above neutral. And if you're trying to get to at least neutral, if not above, well, the kind of minimal neutral estimate out there is 2 to 2.5%. 450 basis point rate hikes is only going to get you to that area. So even if you thought the Fed didn't need to go beyond neutral, and we think that they will, 450 basis point rate hikes made a lot of sense. On that topic of do they need to go beyond neutral, it goes back to inflation. Are we going to see inflation slow down enough? And that's, goes back to the earlier conversation around the ECI. If the ECI continues to be strong, we see employment costs that are rising, that inflationary pressure will only be brought down by putting some restraint on the economy, which means interest rates above neutral.
At the moment, though, they don't have to choose between growth and inflation because growth is robust. Andrew, there are people teeing up a decision at the end of this year into next year where they will have to make that choice, a choice between supporting growth or smacking inflation. You think that when they have to make that choice, they'll keep going at the inflation side of the mandate. Now, Andrew, I wonder what's guiding you towards that, because some people have their doubts still that when the choice comes, push comes to shove, a lot of people believe they'll just tolerate higher inflation and support decelerating growth. Why do you take the other side?
Right. So first, I agree with the idea that that choice is going to get a lot harder as we get towards the end of this year. There may be a real trade-off between growth and between inflation. And I do think that the emphasis will continue to be on bringing inflation lower. I think carefully, I think cautiously. I think certainly Fed officials are trying to achieve the best version of something that looks like a soft landing that they can. But at the end of the day, this is an economy, this is a country that experienced the 1970s. And if you are a Fed official right now, I think the risk that you are protecting against is a repeat of the 1970s. And what happened in the 1970s was concern about growth, which led to not enough concern about inflation, and a decade plus overshoot that became very difficult to bring down, and ultimately a worse scenario for growth. It involved multiple recessions, basically, to bring inflation back down. So I think that's what the Fed is protecting against, and I think that's why they stayed focused on inflation.
Andrew, it's been brilliant to follow your research, you and the team, over the last few months. Just fantastic as the world has moved much closer, much closer to you, sir. Andrew Hollenhorst of Citi. Andrew, thank you, buddy, as always. Lisa, this is the issue right now, isn't it? Two-part debate. The Fed wants to get back to what they think is neutral. One, the debate is what they do after that.
And you really nailed it when you said when they actually have to choose between growth and inflation, are they going to choose fighting inflation over hampering growth? And that, I really think, is a key debate at a time when the Fed has not shown the willingness to do that in the decades that came before.
We're going to have this conversation with Oksana Aronoff of JP Morgan Asset Management in the next hour. We'll be talking about the equity market with Seema Shah and Jay Pawlowski. Jay Pawlowski to get his view on China and what that means for Europe. Looking forward to that from TPW. And then Dan Ives of Wedbush on Twitter as we report we could have a deal as soon as today. From New York, with futures down 0.7 to 1% on the S&P, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned that Twitter is on track to reach a deal with Elon Musk on that $43 billion takeover offer as early as today. Musk is lining up partners for the acquisition and continues to speak to potential co-investors. Still, the talks are said to be fluid and a deal could be delayed or fall apart. It would be one of the biggest internet acquisitions ever. U.S. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin met with Ukraine's President Volodymyr Zelensky in Kyiv Sunday night. It was the highest-level U.S. visit since Russia invaded 2 months ago. The U.S. promised Ukraine more military aid, and Austin said that Washington wants to see Russian forces ground down so they can't attempt a repeat of the war. In China, the coronavirus outbreak has gotten worse. A rising number of cases in Beijing has sparked jitters about an unprecedented lockdown of the capital. Policymakers are trying to avert a Shanghai-style crisis that has already wreaked havoc on that city. And Blackstone is expanding its real estate bet across the U.S. It has agreed to buy PS Business Parks for $7.6 billion. That represents a roughly 12% premium to PSB's closing price on Friday. The deal gives Blackstone about 27 million square feet of industrial business parks, office and rental housing properties. They're located in California, Miami, Texas, and Northern Virginia. And the U.S. Supreme Court hears arguments today in the case of praying football coach Joseph Kennedy lost his job at a public high school outside Seattle after repeatedly taking a knee to pray alongside his players after games. The case gives the court's conservative majority a chance to relax the separation of church and state. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
City of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We see a bit of excessive hawkishness, being driving markets at this juncture. At the end of the day, I see a rate backdrop that's going to be somewhat more conducive or supportive of equities. And then it's a relative call, right? I mean, in this environment, the place you don't want to be is in fixed income.
Jean Bovin of BlackRock Investment Institute. A really interesting conversation. Someone widely tipped to someday run the Bank of Canada. We will see on that as well. Lisa Bramwitz, Tom Keith, thrilled you're with us. And here on your equity debacle of Friday and on the continuing debacle this morning, Gina Martin-Adams joins us, our chief equity strategist for Bloomberg Intelligence. What is your single clarion note this morning on what happened Friday?
Oh, I think Friday was a continuation of what happened all week last week, and that is the market starting to get quite concerned that interest rates are going to go much higher, much faster than we had anticipated, and some concern that the Fed is going to really attack the balance sheet with quantitative tightening en masse. I mean, I think that the market was sort of tiptoeing its way into pricing a tighter Fed, but now we're just going full steam ahead into pricing a tighter Fed.
Is there a partition of profitability? Because what I see is profitability companies seem to be doing okay.
Yep.
And wow, the less profitable companies are getting hammered.
That's absolutely the case. And one of the problems we have is those mega cap stocks that were the most profitable, especially in 2020 and 2021 when we were all sitting at home. Those stocks in particular are really getting creamed because not only are they less profitable than anticipated right now, but they're guiding us to suggest that they may produce slower growth pace into the longer term future. That combined with higher interest rates reduces the amount that investors are willing to pay for those stocks. And let's not mince words. This is the group in the index that is absolutely the most expensive, but also the biggest. And so you see this distortion play out as a result of those stocks in particular. The index is down. Now, in the aggregate, earnings are fine. Frankly, they're actually beating expectations, but it's difficult to notice when the mega caps are missing.
Well, Gina, that's exactly where I wanted to go. I mean, I was looking at a Jonathan Golub of Credit Suisse note that just came out where he was saying strong results just can't get no respect, and that there have been incredible results. And frankly, it's been all in the margins, the profit margins, which have held up well better than people expected. No one cares. It's all macro. At what point do the margins start to matter again?
Yeah, they will matter. I mean, our view is that margins are actually somewhat mixed. And that might be a source of weakness because we are coming from a point where net income margin growth was extraordinary, operating margin growth was backing that up, and over the last few quarters we've seen some chinks in that armor develop. So I do think you want to be pretty cautious on margins in the short run. We do need to see stabilizing conditions in terms of the supply chain, which we're not seeing right now. We need to see inflation peak before we can get some confidence that margins are generally fine and going to be fine going forward. That said, companies are beating expectations on the top and bottom line so far. So this margin weakness that we're seeing when we specifically highlight margins is not necessarily showing up in the aggregate. It really is a company by company, industry by industry, sector by sector specific phenomenon.
Yeah.
And unfortunately, the results of that are, again, these giant companies that really dominate the S&P 500 are proving to be areas of weakness, whereas the tinier companies, call them the energy stocks of the index, or the materials or industrials companies, are generally doing okay, and in many cases better than anticipated. But they're smaller. They can only have so much of an impact on the top line.
But Gina, this is actually somewhat radical what you're saying, because most people have been saying the biggest companies, the multinationals, are able to actually have pricing power, able to pass along some of the costs to consumers more easily, able to absorb some of the supply chain issues. You're saying that the earnings are showing the exact opposite?
Well, for so far, the communications companies have been very weak. So let's take Netflix as a perfect example of a mega cap company. Used to be one of the top 5 companies in the S&P 500. Now it's down to closer to number 50. Nonetheless, that's a good example of a company that has generally been sort of a darling of the market. This is this quarter's biggest weakness, is Netflix so far. Last quarter, we had the same thing happen with Meta, formerly known as Facebook, really disappointing expectations. expectations. It's not necessarily that they're disappointing short-term expectations. It's they're disappointing a combination of long-term expectations as well as they just can't sustain the pace of growth that they had during the pandemic. And in many cases, if you've got regulatory pressures emerging on this space out of Europe over the course of the last month, you've got interest rates rising, which depletes the valuations for these companies more than others in the index, and that underlying concern about earnings and the longevity of this growth story that's hammering this space. So it's communication stocks so far more than tech stocks. We'll find out this week from the likes of Apple as well as Microsoft, if it's embedded in the tech space too. But it's more this sort of communications, media, tech-ish space that has proven to be the biggest weakness.
You and Lisa are way too young to remember where utilities had value. In the last 10 years, they stunned me up 13%. Dow Jones Utility Index, it has cratered 3% off the peak.
Yep.
Is it like traditional? You can hide in utilities?
And utilities, even healthcare stocks performing quite well as investors have moved into low volatility. Specifically, the risk there is they also are low margin entities, in particular in utilities and staples.
Right?
They're not profitable companies. They're low vol, and investors hide there when they're worried about the overall volatility of the market. But will they ultimately produce that profitability for you that the rest of the market will? No. And so investors move into them on a short-term basis, generally looking for opportunities to emerge in a more cyclical industry as volatility calms down. But right now, they're getting the benefit of the doubt on vol. The other thing that is a big risk in this space, I think, is if the longer end of the curve starts to really take off, this space is very debt funded. So not only are they low margin, but they have a lot of debt. They're very reliant on the debt markets. You've got to be quite careful not to over-attribute to some of these low-vol securities.
Gina Martin Adams, thank you so much. Greatly appreciate it this morning. Lisa, I look at the Standard & Poor's last decade up 15%, and utilities are up like 13%. Do I want to give up only 200 basis points for that kind of comfort? I don't know.
Well, and what does comfort mean in an era of rising rates when utilities have traditionally tracked that market more than anything? I want to just point to Twitter. Shares up, still really holding the gains, up 4.6%. And I do want to point out that on Twitter, trending is RIP Twitter. There is a lot of disagreement about the future of this platform and unease that I can feel in a lot of people's tweets about what free speech means. And I'm not offering up an opinion because, frankly, it is very hard to say what it is. There is a fear, though, of the unknown and what Elon Musk's version of free speech is at a time when a lot of these social media platforms really have become the town square, right? Basically, the place where people go out and give their message. And I do think that that is going to be a massive discussion as we head forward and talk about Elon Musk as the owner.
The massive distinction there, Lisa, is we presume it will be a private company.
Yeah, that's the presumption given the fact.
That's not said enough.
And we don't understand who's participating necessarily in this bid, but the fact that Elon Musk got broad-based support from Wall Street speaks to the strength of this bid.
Well, we will see, and it's an ongoing story through the morning here and close to the close this afternoon here on Bloomberg. Futures at negative 19, Dow futures, well, they're doing better than 2 hours ago, 133 negative on Dow futures. Please stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
falling energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City for our audience worldwide. Good morning, good morning. Equities down hard in China, less so in Europe, and in the United States we recover just a little bit. Futures are down a third of 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Live from New York, we begin with the big issue. Lockdowns in China rattling investors.
The Chinese element of the story is dominating on the day.
Widening lockdowns across China.
China is continuing to be very strict.
Potentially a big policy error.
That concern is intensifying across the board.
We're having a risk-off moment.
Stocks running out of steam.
Renminbi coming down.
There could be more downside.
China is just one of the factors.
All the cyclical dynamics we're seeing are pretty much unprecedented.
That added to inflation, real positive rates.
It's very hard to make long calls.
Big question mark and a big uncertainty for the global economy.
Joining us now, TPW's Jay Pilowsky, Seema Shah of Principal Global Investors. Seema, first to you. You've cut your call on Europe. You've done the same on EM. Is China a big part of that story?
Actually, we're a little bit more positive about China, and I know that sounds surprising when you hear about the news today, but we are taking some confidence that they're going to be trying to move policy in the right direction. Now, it's only a neutral call at this stage, and I think having seen the performance of Chinese stocks recently, I think the valuations are certainly more attractive, but this is not the time to go overweight given the amount of uncertainty that lies ahead.
Local media reporting in the last hour that Beijing is to request mass testing for a second district. The fear is that these lockdowns spread from Shanghai to Beijing. Jay Pilowsky, do you take that more constructive view on things happening at the moment?
Well, it's definitely a challenge, John, right? I mean, we seem to be hit no matter where we are in the tripolar world, whether it's Europe with Ukraine and Russia, whether it's China now with COVID again, or whether here it's in the States with just keep adding to the rate hike expectations and extrapolating ever higher. So it's challenging to be an optimist, but as Seema said, valuations are reasonably compelling. Earnings growth is better than expected. And for all the doubts about the economy, the data continues to be pretty robust, especially in Europe, for example, with the recent PMIs being not at all recessionary.
Jay, you're perfectly positioned to talk about this cross-asset. The FX channel here, Something's developing now that did not develop last year, and that's some Chinese currency weakness for a fifth straight session. A move on dollar China of 0.9%, 1 full percentage point, that kind of stuff is pretty rare, Jay. How are you internalizing those kind of moves?
Yeah, it's absolutely right, John. And it's funny you mention that because the reserve cut requirement today after the close in China is the opposite of what they were doing a year ago when they were worried about too strong currency in China, and they were raising that reserve rate requirement. So, I mean, I think in essence, the currency is not a huge issue for China at this point. They control the currency. They're highly unlikely to let it get out of hand. We had a view a couple months ago of China 2022 being a glide path. That's been completely wrong this first quarter. It's been anything but a glide path. So I'm a little bit hesitant to make too many opinions about the near-term future. But in essence, I think China has the policy flexibility, both monetary and fiscal, to deal with the situation. And they have the experience to deal with COVID. For example, plants in Shanghai are already restarting production. So yes, they shut things down quickly, much more aggressively, very different than the rest of the world, and then they gradually reopen. And I think that's going to continue to be the case throughout this year.
Some of the biggest moves we've seen in Chinese markets going all the way back to spring 2020, February 2020 to be precise. Joining us now to discuss that, Kaylee Lyons. Morning, Kaylee.
Good morning, John. Well, that Forex reserve ratio cut that you were just talking about did not come in time to boost sentiment in the Asian session overnight. As you said, the CSI 300, that benchmark in China, having its worst day since February of 2020. It is now at its lowest since April of that year. This is clearly a market concerned about COVID zero policy and whether or not stimulative measures coming from Beijing are going to be enough to support the economy in the face of that. And of course, this was not just a sell-off limited to Chinese assets or to Chinese stocks in particular. It's really rippling across assets across the world, weighing heavily on the commodity complex. You have Brent crude down more than 4%, 102, a little south of there, a barrel trading at the moment. Then you saw big moves in iron ore and a lot of the metals overnight. The Bloomberg Industrial Metals Index is off by about 3%. At the same time, you're seeing a haven bid into the likes of the U.S. Treasury market. That 10-year yield down 8 basis points to 282 or so. And of course, you're seeing a stronger dollar as well. And as you were discussing, a weaker Chinese yuan along with that, John. The Chinese yuan at its weakest since November of 2020. So that maybe is why you're starting to see the policy response and that Forex reserve ratio cut that you were just talking about. Finally, I would note as well that this is reading through into the ADRs of Chinese companies that are listed here in the U.S. Alibaba, Baidu, JD.com, NIO, all down in the ballpark of 2 to even close to 4%, John.
Kaylee Lyons, thank you. There's enough to get gloomy about, that's for sure, right now. Looking over to China, Jonathan Goldberg of Credit Suisse just put out this piece in the last hour or so, just reminding us actually what we expected on earnings at the start of the quarter and what we're getting so far. Jonathan Goldberg wrote the following. At the beginning of 1Q22 and the reporting season, consensus expectations were for 4.3% EPS, with many investors and pundits expecting an outright contraction in profits. At the current pace, he says, 1Q EPS growth should end at 11.9%. Margins are contributing 80% of the upside. Those numbers, that data coming from the team at Credit Suisse. Seema, does that play into your view of the world at the moment, that perhaps we've got a little bit too gloomy too soon on earnings?
Yeah, you know, Jonathan makes such a good point there. And I think for investors, look, we know that there is probably weakness coming, given all the various dynamics with the Fed tightening, Europe, the conflict. You know, there's so many things, but we have to make sure that we're not too early to this negative feelings. So, you know, we can see that the recession chances will probably start to increase pretty drastically in late 2023. But for the time being, actually, the growth indicators are quite strong. So we would still anticipate a positive year for earnings growth, certainly not as high as we saw in 2021. These are kind of single-digit numbers, but still strong enough to get some positive returns.
Seema, geographically speaking, do you still have a US bias?
We do. We look at this and we say, look, you know, fine, the Fed is, of course, tightening more aggressively than what you're seeing in Europe. But the reason is that the US is less vulnerable to a lot of the dynamics that are out there. We continue to see households very much flush with cash. We see that balance sheets are still very, very strong. All this excess savings does mean that companies continue to have pricing power. So for that reason, we continue to like the US, although admittedly we have dialed down that risk a little bit.
Why did you dial it down? Just out of interest.
Yeah, partly because, you know, we can see that the growth outlook is softening. But I want to be, you know, we have to be really careful here. As we said before, it's not recession for 2023. So that softening growth outlook does mean that the risks on the downside are starting to build up. So in terms of kind of picking up pennies in in front of that steamroller, we want to be really careful. And I think for that time, it makes sense to be a little bit more selective, pick out your sectors more carefully, and bring down some of those risk levels.
Jay, on that US bias, that tees you up perfectly, because I know from experience you take the other side of the trade in a big way.
I like pain, John. What can I tell you? I think, look, the markets are in a state of confusion, talking about 14 rate hikes in the cycle and then a recession in the U.S. Same in Europe, talking about 2 rate hikes this year and a recession next year. I mean, there's just inconsistencies kind of across the board, almost wherever you look. And our view has been and continues to be that we're in a high nominal growth rate environment. So inflation plus real growth, probably 6 to 8% in the U.S. and Europe this year versus pre-COVID 2 to 4%. And markets and investors are having a hard time understanding that. And it plays right into Jonathan's point on the earnings. Earnings expectations in the U.S. and Europe this year, single digit, very, very beatable in a high nominal growth rate environment. And so those are that's one of the things that keeps us positive, along with the idea, the sense that sentiment and positioning and all these things are at very 20-year lows across almost anything you want to look at. And so, yes, we have been underweight the U.S., overweight non-U.S., particularly with a focus on Europe and China, which has definitely been painful, as well as Brazil. And look, I think the market is throwing up all sorts of opportunities, particularly right now in the commodity space, given the sell-off last week and early this week. You're having an opportunity to step back into some of the things that got really hot. And it's an example of what I think is a rotational market correction rather than a systemic market crash.
Jay Pawlowski, Seema Shah, are going to be sticking with us into the opening bell. Big tech, a big week coming for them, coming right up. We'll talk about that in just a moment. A big morning for Twitter, getting very, very close to the offer price of Elon Musk. Ed Ludlow on the West Coast taking a look at this deal. Ed, the reporting this morning suggesting that perhaps it could happen today.
Yeah, good morning, John. It seems we're in the final stretch. According to sources, Twitter's board and Elon Musk's representatives were working into the early hours of this morning. A deal could come as soon as today if things go smoothly. We're working towards the original deal, $54.20 a share, values Twitter at around $43 billion. You look at where we are in pre-market, up 4.8%. We're closing the gap, trading at above $51 a share if we hold into the open on where that is. The key piece of reporting, John, according to sources, Musk is continuing to talk with potential equity partners for the bid and vet potential co-investors. You remember that he secured financing of $25.5 billion in various forms of debt from some of the biggest names on Wall Street, including Morgan Stanley, Bank of America, MUFG, but the $21 billion would come in equity financing, either out of his own pocket or from a potential partner. And that is the part of the process that's still ongoing. And John, as with any deal, sources telling us that things could be prolonged or that they could fall apart altogether. We'll have to see what happens throughout the day.
What an interesting moment for this company. Ed, we're going to touch base with you around the opening bell, buddy. Looking forward to it. And we'll catch up with Dan Ives of Wedbush in just a moment too. Coming up, a big week for big tech.
I think the earnings this week are going to be important, but I think it's what they say about the future and the problems that we're seeing out of China right now that is going to be important for any of the hardware makers.
That conversation up next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're still in that knee-jerk reaction of rates are going higher, growth is slowing down, so sell technology. And I mean, you've seen some of the tech stocks hold up pretty well. And I think the earnings this week are going to be important, but I think it's what they say about the future and the problems that we're seeing out of China right now that is going to be important for any of the hardware makers. But if you just think about technology in general, I think we do have to start thinking of parts of it.
A big week for big tech coming right up after Netflix results triggered a $1 trillion haircut from the NASDAQ 100. Bloomberg's Taylor Riggs dropping by to get us up to speed. Hey, Taylor.
Yeah, John, certainly a big week, so make sure to be tuning in, of course, after the closing bell. I want to start with, of course, maybe one this morning, Activision Blizzard. Typically, maybe not a big tech, except that Microsoft, of course, still underway to try to buy that company. So looking for any guidance, of course, ahead of that. And then, of course, we will hear from Microsoft on Tuesday. And then, of course, we'll be heading into Alphabet. BI out with a really interesting note this morning, saying YouTube ads are seeing 2 times faster growth, of course, than Netflix. So further commentary, of course, on the ad market space. And then we'll round it out with that consumer focus. We'll have Meta, Amazon, Apple, and yes, Twitter, of course, on Friday. You changed up the board, and John, sort of the print coming into this doesn't look good. The NASDAQ 100 having the worst month, almost off now, 10% since the Lehman failures. You really have to go back many years to see this type of big declines here so far for the month. Real big refocus here on rates and, of course, what it means for those valuations. Not just a big tech index, though, John, but some of the big individual names within that sector also down. Only 18 members in April are up in the NASDAQ 100. 40% of that index is down by double digits. Netflix, as you can see here, you're off about 43%. The worst performer in the S&P now for the year, you're off 64% year to date.
Taylor, let's bring that calendar up of earnings this week. Of all the companies that report through the week, what have you and the team at the close got your eye on?
Well, trying to balance it all at 4 o'clock, of course, first. But I think as you think about not only sort of the M&A environment, Microsoft arguably maybe the only one that can actually get it done, given they've gone through sort of their M&A regulatory scrutiny a few decades ago, and then really pushing forward to Meta. Remember, sort of with Netflix, John, they had guided us down earlier, similar with Meta. Remember, last quarter, they've also guided us down. So that will be sort of a further reaction here. And then it has to be that consumer focus as we think about the health of the consumer in this environment, Apple and Amazon, and dare I say it, Twitter? Can we do that?
I think we've got to, haven't we, at the moment, Taylor? Thank you. Looking forward to the show through the week after the bell. Taylor and the team reporting the earnings. I'm looking forward to Apple just to kind of get a read on China, given what's happening at the moment. For the NASDAQ 100 this month, down 10%. And heading for its worst monthly decline, going all the way back to 2008. Stuart Kaiser at UBS ran in the following this morning. A further step higher in hawkish FOMC pricing put markets and tech in particular under renewed pressure. Ultimately, we see improved risk-reward for the NASDAQ 100 as easing inflation in coming months will allow the Fed to soften rhetoric. Jay Poloski, Seema Shah still with us. Seema, can you speak to that, please? This relationship between the Fed and the damage that's been done to the NASDAQ 100.
Yeah, I mean, look, the Fed's hawkishness is really driving bond yields higher, as we've all seen, and this is really challenging those big tech companies. I think Stuart's point there, it's interesting. Look, I think we can see inflation probably peaking within the next couple of months, and I think there's going to be downward pressure on bond yields from here on at some, within the next couple of weeks. Because if you have any kind of forecast for recession within the next few years, that is going to push down on bond yields. So hopefully the most challenging time for big tech is almost behind us. And then when we look beyond that outlook into kind of 2023, if you think about the more challenging economic environment, that's a time when you still want these very big balance sheet companies with the cash flow and the pricing power. But I do think that the next couple of quarters could be particularly difficult for these ones because of, you know, they were COVID beneficiaries. So that dynamic is starting to fade.
Jay, what would get you excited about these big US tech names?
Well, I wrote a piece 2 weeks ago, John, called Fever Break, where I argued that the inflation peak is already upon us, and the next several months are baked in for lower numbers, and posited what would happen to stocks if by July, let's say, inflation is down from 8 to 5, heading lower, growth is okay. Where do stocks trade? And I think where we're taking our kind of tech bet and tech exposure is not in the FANG names. Those are the old style growth. We're focused on innovation and new growth opportunities. Tesla is a perfect example, John, right? Reported last week, blowout numbers. Stock was up 10%, and then we had Jay Powell speak about 50 basis points in May, and that gain evaporated. Probably going to trade below that open post-earnings today. And so I think the market, again, is kind of really confused, taking stuff right up front and discounting that immediately without really thinking about the longer term. So to us, valuation is compelling. All these cyber names, fintech names, climate names, the thematics have all round-tripped. Valuation is compelling. They're cheaper than the private markets. There's M&A opportunity, as we're seeing with Twitter, as we're seeing with cyberspace in recent weeks. So to me, that's where the opportunity lies. But I think we are at the peak of inflation. Rates on the 10-year, 3% is a very tough level to get through. We're probably going back to 2.5, 2.4, and then gradually work higher if we're right on our view of higher nominal growth, not just in 22, but also in 23 and 24.
Jay, you made a couple of points there. Let's pick up on two of them. I want to go, first of all, with Twitter and Tesla. On Tesla, something that wasn't asked on the call in the last week was the issue with Twitter. How much key man risk is there at that company? And how distracted do you think the CEO will be, given what's developing this morning with Twitter?
Yeah, it's a great question, John. And I actually think not very much, right? I mean, just think about what Tesla's been able to accomplish. In the last month, they've opened 2 state-of-the-art production platforms in 2 separate continents. That's why we call it one of the world's first tripolar world companies. They have production in Shanghai, in Asia, production in Berlin, in Europe, production in California, and now Austin in the United States. It's unparalleled. They've been able to maneuver through all these shortages and semiconductor issues, et cetera, et cetera. They've bought up their battery supply. They're so far ahead of the rest of the competition in the EV space, and they will be able to sell every EV vehicle they produce over the next couple of years without any problem. They're going to max out on production for the next several years, and yet the market has no idea of how to value them, and so it trades up and down crazy. I don't actually think there's very much key man risk in Tesla.
Jay, what do you say to the doubters who look at Netflix and a performance, say, in the last week and say, well, they didn't used to have competition and now they do in a big way, and look at this. And they look at the likes of Tesla and say, well, look at what every single automobile company manufacturer on the planet is doing right now. Surely they make a dent in everything that Tesla's achieved. Why do you push back against that, Jay?
Well, because I think the demand for EV is just going to be off the charts across the world, right? If transportation and power generation, John, are the 2 areas where we need to get carbon down dramatically. EV addresses the transportation, and if you look at projections, you even just look at the sales this year. It used to be 1 million EV vehicles a year. Now that's being done in a matter of months. So the production and the demand is going to expand considerably around the world, which is why Tesla is uniquely positioned. They have production platforms in each region. Nobody else does. Just look at their ability to produce this quarter versus the traditional auto names, which have not been able to make the move and then establish their supply chains for lithium, for copper, for nickel, the things that go into the batteries, and so for semiconductors. And so to me, it's a different ballgame. And I'll just quote the Morgan Stanley analyst who said, you know, when we look at Twitter's recent results, our concerns are for the ability of the rest of the industry to catch up. In other words, Tesla is expanding its lead, not its lead is not contracting.
Seema, I want to give you the final word. Jay made a few points. One was on Tesla, another was on getting inflation back down. We might have seen a mechanical peak in CPI, but to Jay's point, if we get back down to a world of, say, 5% inflation, Seema, how do you expect this market to trade around now?
Look, if you've got inflation about 5% at the end of the year, the Fed is still going to be very, very uncomfortable. So at that point, they still need to move above neutral. They still need to be moving pretty aggressively. And the only scenario where they don't do that is if they're willing to sit with inflation above 3%, which I have to say, it's a theory which is becoming more and more popular. And I think we're starting to buy into it a little bit more.
That's the one that gets my attention too. Seema Shah, Jay Pawlowski, to you both, thank you very much. And Jay, thank you, sir, for your views on Tesla and Twitter as well. We're going to be talking about that in just a moment. The morning calls next, and later, Twitter is said to be on track to reach a deal with Elon Musk potentially as soon as today. Dan Ives of Wedbush joins us very shortly around the opening bound to discuss that stock of 51.15. The offer, as you know, 54.20. In the pre-market, 7 minutes away from the opening bell in New York City, things recovering on the S&P 500. Futures negative just 0.4% after the carnage in China spills over to Europe, and earlier this morning spilled over stateside as well. We erase those losses. From New York, this is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Three days of losses on the S&P could become four. Futures down about 0.5%. On the Nasdaq, we are lower for 3 straight weeks coming into this week. That is the longest weekly losing streak going all the way back to last year. It has been that long, the longest losing weekly streak of the year so far. The Nasdaq on the month down 10%. It has been ugly for that particular index. That's the price action. Here are the morning calls this morning. First up, Goldman downgrading Verizon to neutral, $55 price target, seeing limited upside potential over the next 12 months. Deutsche Bank downgrading Kellogg to hold, expecting inflation and supply disruptions to remain a risk. And finally, Raymond James upgrading AMD to a strong buy, pointing to the chip maker's attractive valuation ahead of next week's earnings report. Their stock is up by about 1% at $89.01. Coming up, Elon Musk said to be closing in on a deal for Twitter. The clock striking midnight for the board of directors. That's the view from Wedbush's Dan Ives. He joins us around the opening bell in just a moment. 4 minutes away from the opening bell with futures negative 0.4%.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
24 seconds away from the opening bell in New York City this Monday morning. Good morning to you all. We are looking at a 4-day losing streak on the S&P after a 3-day losing streak coming into Monday. On the Nasdaq, we're lower too by around about 0.5%. On the Nasdaq 100, a brutal month for that particular index, and we take some more weight off it. That's the opening bell. Switch out the board and get to the bond market. Your 10-year yield looks a little something like this. Yields lower by 9 basis points to 280.63. The concerns about lockdowns in China spreading from Shanghai to Beijing spreading right the way through this market, with crude down by more than 5 percentage points to a 96 handle on WTI at 96.35. The dollar rip-roaring strength. Euro dollar 107.26. Euro dollar negative 0.6%. That's the early morning price action at the opening bell with some movers. Let's get to Katie Lyons. Hey, Katie.
Hey, John. Well, a lot of movers this morning are tied to the story in China. Fears about a lockdown potentially in Beijing, what that is going to mean for economic growth, supply chain issues, and of course, demand for commodities. As a result, you're seeing some supply side sensitive stocks like the semiconductors under pressure. Nvidia is one of them, down about 1.7%. Then on the commodities demand side, you're seeing oil lower, the metals lower, and that is translating through to commodity tied stocks like Freeport-McMoRan, which of course operates in the metal space. It's down 4.6%. There are some earnings stories out there as well, including Philips, which of course is the Dutch medical devices maker. It reported earnings in the European hours this morning, basically warning of persistent supply chain challenges and said inflationary pressure may stick around for years. A big miss for that company. It's down 11.5% as a result. But on the more optimistic side, yes, dealing with inflationary pressures, but passing those costs on to their consumers through price hikes. Coca-Cola beating on the top and bottom line, revenue up, organic revenue up 18% in the quarter. That stock up about 2.6% at the open, John.
Kelly, thank you. About a minute and 25 seconds into this session, here's one to watch. Twitter up by about 4% in early trading. We are trading in the 50s and getting closer to that offer price of Elon Musk of 54.20. Something has changed over the last week. Let's get to Ed Ludlow on the West Coast for more. Ed, what changed?
Yeah, it's interesting. What changed, according to sources, is that Twitter's board started to take this offer more seriously when Elon Musk disclosed that he had the financial commitments from Morgan Stanley, Bank of America, Barclays, MUFG, a whole list of other banks who were providing $25.5 billion in debt financing. But you look at Tesla, we're down 2.4% Tesla. Sources tell us that the missing piece here is that Elon Musk continues to line up equity partners. So there's $25.5 billion of debt committed, and then Elon Musk himself is committing $21 billion of equity financing. But if he does not find equity partners, one option is for him to sell some of his Tesla shares to fund a part of that equation, which I thought was interesting. According to sources, this is the final stretch, John. We could have a deal announced as soon as today. The board worked into the early hours of this morning with Musk's advisors. There's reporting from what happened over the weekend. In fact, it's kind of a replica of what we saw from the Easter Passover weekend when Elon Musk had his advisors and bankers working that Saturday night into Sunday morning so that we had something for the following Monday, very much playing out in a similar way here. But as with all deals, John, and we say it time and again, sources are warning us it could go on, could stretch out, and could be called off altogether.
Ed, what are you hearing about how complicated the financing and the backing is for this particular bid?
Complicated in the sense that Musk was speaking for different types of equity partners, a wide range according to sources, family offices, high net worth individuals. Then there's the role of private equity, right? We know that Thoma Bravo was coming in. We know that Apollo was coming in. And interesting, in the case of Apollo, sources told us that they could back a Musk bid, but they could also go to Twitter and help them ward off this kind of takeover attempt. I think you're, listening to Dan Ives, for example, Wedbush, some of the other street analysts, what did not happen was a white knight did not come in, right? And so now Elon Musk has options, but the board does seem amenable because of that debt financing that Musk was able to secure.
At another company you report on, Tesla, it is trading lower by about 2.5%. No drama here, not a massive move, but have we got a clear read on what it could mean for that company?
Yeah, there's lots of split opinion on this, right? Why is Musk doing this in the first place with Twitter? Is he distracted from leadership at Tesla? I thought it was very telling on the Tesla earnings call that Musk did not speak first. Zach Kirkhorn, the CFO, did. Drew Baglino, who's the SVP for energy and drivetrain products, took a lot of ownership on the call. So there's a company there where other lieutenants are getting involved. Musk spends a lot of time on Twitter. He has done for years. He's spending a lot of time, my sources tell me, at SpaceX. This is status quo for him, right? And this is just his latest endeavor.
Hey, Ed. Thank you, buddy. Ed Ludlow on the West Coast. You mentioned Dan Ives. This is the view from Wedbush and Dan Ives. The Twitter board could not find a white knight. The clock has essentially struck midnight for the board, which is why negotiations are underway to get a deal done. Dan Ives joins us right now. Dan, do you believe this deal closes today, and why?
I think a deal gets done in the next 24 hours. But because ultimately, as Ed talked about, the financing, once they laid it out, that really put feet to the fire from a board's perspective. And they ultimately needed a white knight, a second bidder to come in. Probably books went around. Private equity basically just couldn't get there. So that's why, from a board's perspective, they had to come to negotiation with Musk, a Game of Thrones, and ultimately it looks like the next 24 hours, Musk will on Twitter.
Dan, have you got a decent idea of what the plan is?
Look, I think, as this goes private, the first thing was turn to a subscription model. Monetize it. They'll lose a significant amount of subs, of probably a $2-3 a month type subscription model. That would increase revenues, cash flow. So I think from a model perspective, that's something that happens right off the board. Of course, getting rid of the bots, cleaning up the platform, potentially combining with some other initiatives, some other acquisitions. I think that's ultimately the goal here, because it comes down to freedom of speech is one thing. He's betting 20% of his net worth on Twitter. So I think that ultimately, now the strategy really needs to be outlaid.
What are the benefits of being private, Dan? Everything you said that they're going to do, what do they need to go private to do that they can't do as a public company?
Well, it's a great question. They could do it behind the scenes. Every quarter, they don't have to answer shareholders. I think that's really the difficult part when you go through a transition like this from a quarterly perspective. And I think that's why they would take it private. Ultimately, maybe over the next few years, come back out and, it could always go public down the road. But look, I think it just came down to the board was looking for a second bidder. They thought a second bidder would come. It never came. Fiduciary, they had to sit down, and now Musk, it looks like it's in a course, I'd say the last stage to get this deal done.
Dan, you mentioned that they'll push and lean heavily on a subscription model. How do you think advertisers will react to this?
I think there'll be clear pushback. And I think ultimately right now, this becomes a lightning rod on both sides of the aisle, in terms of how this ultimately is going to sort of as a platform. And for Musk, there's political risk in terms of for Tesla, for SpaceX. I think that's why you're seeing that react accordingly in terms of shares. Ultimately, the equity financing that Ed talked about, I think that's something that he just got $25 billion of stock from a target that they reached. So I think that's a big issue. But no doubt, what you're essentially doing here in the eyes of many, you're trading caviar for a New York City hot dog. in terms of Tesla for Twitter shares. And it's a head scratcher, but ultimately it looks like probably by the end of the day, this deal gets done.
Dan, you just said something really interesting. You think this invites risk, regulatory risk, for the likes of Tesla and other Elon Musk ventures because of what he might do with Twitter. Can you just build that out a little bit more?
Look, at the end of the day, from a Tesla shareholder perspective, this is not what you want to see. There's no benefit for Tesla or SpaceX, but it invites, both in the Beltway as well as Brussels, more of that polarized view, right? Some view Musk as a hero, others view him as a villain. It just increases that sort of, I think, noise at a time that Tesla investors don't want to see it. So let's just be clear. That's what Tesla sells off here. As a Tesla investor, buying Twitter, that's not what you want to see. But it is what it is. Musk is going to get it. There is no second bidder. And now it's really just a matter of, I think, timing and, sort of dotting the I's, crossing the T's to get this done.
Dan, just on key man risk, Jay Pawlowski of TW joined us in the last hour, and he said he doesn't see it at Tesla. I know a lot of people who do. Where do you stand on that, Dan?
I think Musk's sole focus, at least over the next year or two, I mean, Tesla's a major focus. We've seen it with the Giga build-outs, of course, with Cybertruck and, some of the issues they have to navigate in China. But balancing a lot of balls here, right? I mean, if you look at the situation with SpaceX now with Twitter, he wouldn't be CEO of Twitter, probably a chairman role. But no doubt, there's going to be a bright spotlight here. That's also why Musk, likely another comp package to make sure he stays on as CEO and chairman, no issues for the next 5 years. But look, it just adds more uncertainty. And just look, go back the last 2 weeks. I mean, the street viewed it was a 10%, maybe 5% chance this deal gets done. Now it's probably upper 90s.
Dan, got to wrap things up with earnings season. What a big week for big tech. We've had a 3-week losing streak on the NASDAQ 100. We're down for a 4th straight session. On the month, we're down by, let's call it 10% now. Dan, the worst month going back to 2008. Microsoft this week. We've got the likes of Amazon over the next week, Apple, Facebook, Alphabet. Take your pick, Dan. How important is this week?
I think it's the most important week for tech earnings probably in the last 7-8 years. Because of the white knuckles, because of the Netflix debacle. You need to see strength on enterprise. You need to see strength on cloud. And of course, from a productized perspective with a name like Apple. So it's a fork in the road week. I believe ultimately bullish and it leads tech higher. But no doubt, I mean, this is, John, I think it's the most important week that we've seen in tech in many, many years in terms of earnings season.
Tell me the names you expect to see strength on relative to the weakness that the market is priced for and the names that you think we will see that weakness realized.
Yeah, so bullishness, I think significantly better in the street would be Microsoft on the cloud story. I think Apple is another one. I think Google in terms of cloud strength that we're seeing on GCP. In terms of negatives, it's Meta, Facebook. Because fundamentally, I think that's the business model has changed there. That's catching a falling knife. So I think it's a bifurcation. And I also think cybersecurity is the pocket that's going to continue to be strong along with cloud.
Dan, just awesome to catch up. Big week ahead. Hopefully we catch up again soon. Dan Ives there of Wedbush with the NASDAQ down about 0.5%, the S&P down 0.75%. Coming up, Senator Warren urging Democrats to get inflation under control.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose.
That conversation up next.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose. Democrats win when they do when they work on behalf of working people.
Senator Warren delivering a warning to Democrats to get inflation under control. Secretary Yellen saying prices are nearing a top.
We want to do everything that we can to lower inflation. And the president has announced an unprecedented release of oil from the Strategic Petroleum Reserve that is serving to hold down oil prices. I think gas prices peaked and have now come down some from their peak.
Team coverage starts right now with Anne-Marie Hordern joining us in D.C., Michael McKee here in New York. Anne-Marie, the message from Senator Warren, pretty clear.
Yeah, it is pretty clear that they have very little time to try to turn this narrative around. And Jonathan, if you've been paying attention, as I know you have, poll after poll, this is top of the minds of American voters. It is inflation. That what comes back every single month for a matter of months. And right now, it's critically important because during election seasons, it's the spring and the summer leading into that November vote where really you start to see voters' minds harden about the policies they care about and the individuals they want to support. And Elizabeth Warren saying they need to do something on inflation. Now, if you listen a little bit more to what she had to say, she gave 3 things that she thinks the Democrats need to focus on. One is about price gouging and having the FTC go after companies for price gouging. 2, putting a stop on student debt, those loans. And then 3, making sure that members of Congress, Jonathan, don't have the ability to trade stocks. She thinks that this is something they could deliver to the American people before November, they'd be in a better place.
I'm not sure how much that will help get inflation down, but I take your point. That's something they could do with the electorate. Number 4, Mike McKee, raise interest rates. That job is the Federal Reserve's.
That job's the Federal Reserve's, and they're not Democrats or Republicans over there. To underscore what Anne-Marie was talking about, though, you go back to 1992, not directly comparable because it was a presidential, not a midterm election year, but we were coming out of a war over oil. Oil prices were elevated, and consumer sentiment, as measured by the University of Michigan, the current sentiment is number was going down into the election, and that it tells you about all you need to know. What Anne-Marie was talking about, it's the economy, stupid. It's what people think before the election about how things are going, and then look at the white line below that. That's consumer current confidence right now. That's bad news for the Democrats shaping up. Now, we'll get a lot of information on inflation this week. Some of it may be a little bit better. On Monday, we get new home sales and home prices, plus a consumer confidence number. We're going to watch not just to see if home sales are slowing, but if home prices are slowing, that would be important for inflation. If you want to argue stagflation, take a look at Wednesday. You get GDP numbers then, and on Friday we get the Fed's PCE inflation number, which is, of course, the one that they target, the 2%. Is the news going to be a bit better? Well, the forecast is yes. We talked about having a peak in inflation last month, and that may be the case. The forecast is we see inflation start to fall over the next months to almost 2% by the end of 2023. But is that soon enough for politics?
Some good news, maybe. Mike McKee, thank you. And as I've mentioned a few times already this morning, no Fed speak this week. Also, good news for many of us. I know. Mike McKee, Anne-Marie, thank you to you both. Joining us now, the wonderful, the brilliant Oksana Aronoff of JP Morgan Asset Management, who for a long time has warned about what's happening in credit, and she's been positioned for it. Oksana, you still say, though, credit risk is not repriced. You have not seen enough damage. Walk us through it.
Good morning, John. No, we certainly have not seen enough damage in credit risk. In fact, history is somewhat informative here. And if we look back, even as recent as the hike that the hiking cycle the Fed went through in 2015 to 2018, a significantly more benign inflationary environment, right? Inflation got up to, oh my God, like 2%, and a higher unemployment rate than what we have today. And we saw not just credit risk go through a more dramatic repricing with high yield spreads pushing up against 500 back then, but also in terms of where the 10-year was. The terminal rate of the 10-year by the time that hiking cycle was over, was about 30 basis points higher than where we are today. So I think not even in terms of the interest rate risk pain, which has been all of the pain that bonds have tolerated so far, even that is likely not done. We do not know what quantitative easing has in store for us. We don't know how that ultimately will work out. We don't know what the path of these hikes will be. And that all will have an impact on where the 10-year will ultimately end up. So this is, this continues to be a time for caution. Certainly some things have worked. They've worked for us as well, certain shorts on, various parts of the curve, as well as on things like emerging market debt, which has repriced more significantly in light of the interest rate risk. But this is definitely not the time to be moving wholesale into credit risk.
Oksana, another thing that worked, because a lot of people piled into it, leverage loans. There was that comfort, and I think you're discussing this. There was a comfort between taking, say, credit risk over duration risk. So people took their exposure, their credit exposure through leverage loans over, say, high yield. Morgan Stanley, the latest actually to close out that position. Are you expecting this pain to spread just a little bit more in a way that it hasn't done year to date?
Absolutely, yes. So leverage loans is the sole sector in fixed income that has been able to generate a somewhat positive return year to date because of its floating rate nature. But of course, these are junk-rated issuers. And as the cost of capital continues to come up, and as they continue to need to refinance themselves in this new higher cost of capital world, that will make its way onto the fundamentals of these companies. And the default prospects should return, for high yield in general, should return to something like the historic average of slightly above 3% and not 0, which is what spreads are pricing in right now. So loans have been sort of this least dirty shirt because of their floating rate nature, but they are not going to be spared the credit risk repricing that the rest of the market will have to deal with.
A part of your playbook is to carry a higher cash load in a portfolio, Oksana. What would you be looking for through the year to deploy some of that cash?
So we don't, we have liquidity not because we love sitting on liquidity, but in this environment, which, we came into the year with a lot of liquidity because we felt this was going to be a very volatile year, but also because we know that that's the part of our portfolio that will reset the fastest, right? So we are essentially right now positioned with, virtually no interest rate risk. We're clipping a coupon where we can to offer, the best yield that we can in a safe manner in this environment. But then it's all about that optionality longer down the road, right? It's all about the ability to take advantage of that opportunity when it does arise. Because remember, and we talk about this every time, John, the liquidity providers are moving away from this market, right? The sell side has continued to do that for quite a number of years because of the sort of de-risking that they've gone through. But also the biggest liquidity provider, the Fed, is now removing its accommodation. And that really is a game changer. So yes, we continue to have a lot of dry powder in the portfolio, north of 60%. But that's what's allowed us to generate a positive return over the last year, that and a number of conservative plays in this market and high quality floating rate plays. And so we're now ready for the next chapter to this saga, so to speak. We're ready to take advantage of that opportunity when it opens up, which we believe it will through the end of the year.
Well, I'm looking forward to catching up with you when that time comes. And before that too, Oksana, thank you. As always, Oksana Aronoff there of JP Morgan Asset Management. That's the credit story. Here's the equity one. We're down 0.8% on the S&P. On the Nasdaq, we're down about 0.5%. This week is a huge week for big tech. Up next, your trading diary and the guide through the week into the weekend. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Five minutes into the session, some real risk aversion out there. 4-day losing streak on the S&P 500, down around about 1 full percentage point. A bit into the bond market. Treasury yields lower by 12 basis points on a 10-year, a break of 280. On the Nasdaq 100, down 0.5%. On the Nasdaq 100, aggressively lower through the month so far, down about 10 percentage points. This is the stock to watch. Can we close a deal today between the board at Twitter and Elon Musk? We trade at 50.78. The offer price, 54.20. It's about $4 of doubt still in that market right there. We'll talk about that through the day. That's the price action. Here's the trading diary. China's health authority holding a COVID briefing. That comes up at the top of the hour. Huge week of earnings with Microsoft and Alphabet Tuesday, Facebook on Wednesday. Then it's Apple, Amazon and Twitter on Thursday. A Bank of Japan rate decision and another round of initial jobless claims. And Q1 GDP to close out the week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010 after staying for almost 1 year in the hospital. He died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions want them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under